All right, let's go ahead and get straight into it. Here is my portfolio update for the last month. I do one of these every single month on the 15th, so be sure to subscribe so you don't miss future updates. But we actually were up a good amount on the month, up on a money-weighted basis, 6.66%, a very interesting number to say the least. And it wasn't thanks to a particular stock we're going to take a look at today, and that is actually Turtle Beach down here. You can see that at least my return's down about 20% on the month, about 18% down on the month. And this is after a horrible earnings call that saw their stock plummet 30% in a day. If we go over to the monthly view or weekly view, I guess, you see this thing just drop off a cliff, about 33% down at some point on the week. And it actually has shot back up about 7 or 8% today. But I'm getting ahead of myself. We'll get back to that in just a second. But getting back to the portfolio view, things are pretty positive, with a lot of gains actually being driven by our friends down here at Sleep Number, which went up huge, conversely, compared to Turtle Beach on their earnings, and I was able to benefit from that. And in general, the rest of my portfolio did all right in the month, and I have been actually trimming down Dropbox here. I haven't really done anything to research or look at this company in quite some time, and it's been a pretty small position anyway, so I've been sort of selling that down, and I've been reinvesting that money into mainly Turtle Beach and Sleep Number, a little bit into Turtle Beach after their recent earnings. I don't know how much more I would be looking to add, but I was looking to add a Sleep Number. Glad I did before their earnings, I suppose. So I was selling that down, and then also trimming down, if we go back to the greater portfolio, into metals. I started selling off copper. Almost all of that was gone. It was about $1,500. It wasn't a huge position by any means, but just getting rid of that. Theoretically, we could be at the top of a cycle there, and I don't do too much research into commodity sort of trends in general. It's kind of, I don't want to call it a feeling play, but this sort of was supposed to be like a basket of metals as sort of an inflation hedge. Copper just kind of went crazy over the last year or two, so I'm just getting out of that and moving it into something that I like better, mainly something like Sleep Number, for example. I was adding to that, so that's kind of what's going on in the portfolio. I will eventually sell off the rest of that, the remaining like $100 or $200 on copper, and I will sell off the rest of this Dropbox stock as well, since it's not something that I'm not really that comfortable with it anyways, because I'm definitely no expert on Dropbox at this point, and I'll just kind of take what I have here and move it into something else that I am more comfortable with. Otherwise, the only other purchase I made this month was a little bit more into Facebook, aka Meta at this point. So I did add a bit more to this. It's close. I don't think it's actually that close to a full position, or at least where I want it to be. And it keeps jumping back up to over $180 or something around there. I'm trying to get it closer to 160. So every time it kind of gets down there, I've been adding a bit more, and I'd really prefer it go a little lower if I were to add quite a bit more. But anyways, I have been slowly adding to this. I added a bit more this month, but really not too much. I think I added $500, maybe $1,000 over the last month. But those are kind of the three I've been focusing on in the last month: Turtle Beach, Sleep Number, and Meta platforms. So those have been kind of the changes in the portfolio. But now let's go ahead and talk about Turtle Beach. This is the holding that I've put the most money into. I don't think it's my biggest holding anymore, because it drops quite a bit. If we go to the all-time view, you can see that I'm down about $8,700, another 666. Something's going on here, guys. I don't know. I'm not too comfortable anymore. But the 75% money weighted return is a little misleading, because I've put 19 grand into this thing, and it's currently at about $10,500 in value, or I should say market value, of course, because intrinsic value is often separate from what the market value is, but intrinsic value is ultimately in the eye of the beholder. Point is, I could be very wrong about what I think the actual intrinsic value is long term, but hey, we'll see who's right in the end. Right now, the market definitely thinks I'm wrong, but I'm at a cost basis of around $19.38 per share, and it's currently trading around $10.50 per share, although it did get as low as I think $9 after the brutal earnings call just a few days ago. And that was mainly on the news that, one, they're losing money, and also that they are not actually planning to go through with any sort of merger or to sell themselves basically to some other firm that would take them over. They are not doing that, or at least that's what they're saying, but that could always change. Obviously, if they get a bid that is attractive to them, that's reputable, that could actually close, but all that aside, investors were not happy with this news. They explicitly said that they were not trying to sell anymore, and that they were trying to just continue going forward with their plan of switching more into kind of PC components or PC accessories, I should say, not components, rather than relying so exclusively on console headsets, which is still a massive portion of their overall revenues, but it has been declining for from a percentage basis as they continue to sell more and more PC accessories, which was kind of my overarching thesis into investing into the thing. Because if we go ahead and take a look at what's happened with Turtle Beach over the years, this is their free cash flow graph, courtesy of Ticker Terminal. And you'll notice something quite interesting here, and that's that things are pretty cyclical in that they go up and they go down, and then they go up and now they're going down. And if we actually go to the trailing 12 months, they're about negative $57 million in cash flow. So that would be twice, about double what their lowest was back in 2015 or so. So significant negative cash flow, a lot of it thanks to selling off overpriced inventory that they bought some time ago. So they're kind of taking those losses now, and it's very, very bad from a free cash flow perspective in that it shows that they're losing a bunch of money, that they overpaid for things and they're selling them at a loss. So now would be a good time to talk about cyclicals, because some companies are like this in that they kind of go up and down with the cycles of some particular market. In this case, it's sort of the gaming console market, because they sell a lot of console headsets for video game consoles like the PS4, PS5, Xbox, all that great stuff. They often pair their headsets with those major consoles, and they get a lot of their sales from that. And obviously we had the release, or maybe less obviously if you're not into the video game space at all, we had the release of major consoles in 2020, and that continued to sell into 2021, really into the first half of 2021, but a lot in 2020 where they had a record year. You also had some added demand towards video games, perhaps thanks to everyone being locked at home during the pandemic, which you could say some people continue to be locked at home, but certainly less than before. But they had a record year. And this is when I started buying into the stock at basically the height of what had happened. And my thought was, okay, I don't expect the console headset sales to continue to be so heightened as they were in 2020. I would expect those to come down, but I think they're going to make their pivot towards PC accessories. And as they do that, they'll be able to kind of maintain at least some of that cash flow, or at least maintain the revenues at a similar level. Because if we put revenue up here as well, this is the black bar, you can see revenues are quite a bit higher than they have been historically. So I was thinking that maybe they'd be able to maintain the revenues at a similar level as they sort of switch towards the PC focus, rather than being so reliant on the especially cyclical market that is console headsets. That was my thinking. And I was sort of right in that thesis, because they are projecting something like $250 million in revenue for 2022. So that still is pretty high historically speaking. And they are getting more and more of that revenue from PC accessories. So things seem to be going okay there, but the console headset market is not doing as well. And people are certainly bearish on just the overall cycle in gaming right now, because you sort of had a lot of excess demand that was sort of pulled forward thanks to 2020 and all the things associated with that. And also you have the recession potential and people not spending as much on discretionary items. So there's that risk as well. But anyways, I think this is a decent lesson for how to look at cyclicals in the future, even though I was kind of right in that they were going to be still at higher revenues than they maybe have been historically, and their cash flows might be fine long-term as they kind of move away towards being so reliant on headsets. Even if that comes true, I still bought at the top of a cycle. And when that happens, when the cycle starts to turn, investors go away because they don't like to see cash flows and revenues decreasing pretty much in any setting. Even though they've done this before, you see kind of the up and down motion in revenues that we already took a look at. But it's something that I didn't quite appreciate when I was investing into the stock. I did expect the revenues to come down. I didn't expect them to stay at these super heightened levels, but I did expect them to sort of use this momentum to make gains in other places. And in some places they have, and other places they certainly haven't. And the jury's still out for as to what will happen in the next few years, which is what I'd be most concerned about, since I am investing for the long term and they don't have a ton of debt to worry about. So that's a plus. But let this be a word of warning before you invest in a more cyclical business, something like a Turtle Beach, something like whatever might be sort of very tied to a particular industry or market cycle. You just have to be careful, because cycles, they are a cycle. They go up and they go down, and sometimes they're more predictable than others. Sometimes they're not. 2020 was a bit of an anomaly for many industries, so it kind of threw a wrench into some of the analysis, but nevertheless, they did clearly seem to be at the top of a cycle. You had a bunch of consoles come online. That is a huge bullish sort of thing for them, but then that eventually dries up. You can only sell so many consoles, and by extension, you can only sell so many headsets with those consoles. So eventually, people aren't collecting dozens of headsets. They're typically going to buy one. It'll last however many years, and they're not going to buy another for a while if they ever buy one ever again. I'm definitely going to pay quite a bit more attention towards the cyclicality of certain businesses and try to get somewhat of an understanding for as to how cyclical the future revenues might be. Am I investing towards the top of a pretty predictable cycle, or what's going on there? That's kind of what I want to focus on in the future when I'm looking at these sorts of companies, or at least companies that have some sort of cyclical element to them. So I'm trying to figure out what to do next with this position. It's already a pretty sizable position. I put a bunch of money into it. Don't want to get into the sunk cost fallacy, but I don't want to be over allocated to any one particular company. There is risk to that. Of course, there's potential for extra reward if they have sort of outsized returns. But hey, if we're heading towards the bottom of a cycle, that's might be unlikely for a while. But who knows, things could always turn for the better, but they could also turn for the worse. The approach very much might be just to sit and wait and see if they can continue to make that pivot towards PC accessories and sort of wait this apparent cycle dip out until we get sort of on an upswing again. Might be a couple of years, might be more than that. We'll see what happens. But I think the best course of action for me, at least, would probably be just to sit tight here and kind of wait and see and collect more information. And we do have the fourth quarter holiday sales coming up, which is always good for something like a retail-oriented brand, especially electronics. You get a lot of sales in Q4, and they definitely have historically. So maybe that will help sort of get things back on the right track as a business from a cash flow perspective, from pretty much every perspective. But anyway, zooming out to the whole portfolio, going to the all-time view, we're back under $10,000 in losses, or paper losses, I should say, since most of this is unrealized. Some of it is, but some of it is not. Most of it is not. And that would be a negative 20% money-weighted return. It contributed $97,000, almost $98,000 to the portfolio. And we're sitting at that's $86,000 or almost $87,000 plus about $2,500 in cash here that I'm trying to decide which thing I should prioritize it to. I do have some margin that I've got to pay attention to as well that I took out against this portfolio to use towards a real estate deal. So I'm going to be moving some money towards that. Probably not out of this portfolio, but new contributions probably will just go towards the margin rather than towards more stock purchases, unless there's just a screaming deal that I really want to go for, which could very well be the case, but I want to be very careful with margin levels since I have about $20,000 worth of margin against this account. I like to get that down a bit before I start getting more aggressive with stock purchases again. And if you want to see my whole portfolio, I'll include a link in the description below to M1 Finance. You can actually copy this portfolio if you want to by chance. I'm definitely not suggesting you do that for your portfolio because your portfolio is your own. You got to do your own analysis, your own research. Your risk tolerance might be very different than mine, and your conclusions might be very different than mine. So I'm not giving you a specific recommendation either way, but if you like what you see, you can copy it over. I have an affiliate link to open up an M1 Finance account as well. That would go a long way towards helping the channel if you want to check out this platform, since it does have some pretty nice features. They have that cheap borrow option as well. And they do have an auto invest feature if you just want to kind of fire and forget. Maybe you're a more passive investor, you don't like all this active stuff, yet you still watch the channel anyways. That's certainly fine. But otherwise, like, comment, subscribe, all that great stuff. And until next time, take care.